The economy is running fairly strong right now, and stronger than I probably would have expected. I was struck by the number that came out on Monday that the number of vacancies in the economy had popped back up, suggesting that we were moving back to a labor short economy. There's nothing that I've ever seen in economic experience that suggests that inflation comes way down, and we've now got inflation at 7, so it has to come pretty far down, without there being some meaningful amount of restrictive policy. And then that restrictive policy also restricts growth and employment in the economy. So I think after a long period when the Fed was really not in the right place at all and almost had its head in the sand, believing in a transitory theory, Chairman Powell's navigating it into the direction, into the right broad area. The market's now expecting that the federal funds rate, which just got increased to 4, will get up somewhere in the 5.10, 5.25 range by next April. My guess would be that the inflation pressures are still going to be a little greater than people suppose from the labor shortage. And so my guess would be that interest rates will end up, Fed funds rates will end up above that. I would not be amazed if they got to 6, but that's certainly not what I would be predicting. I think it's very hard to know what's going to happen to inflation and unemployment. My instinct is that in some ways it's easier to forecast the two of them together than to forecast one of them alone. If we are actually on a path that brings inflation back close to the 2% target, I think we're likely to have seen a meaningful increase in unemployment. But whether we will actually push the process as hard in terms of disinflation, I'm less certain. But I think the more serious way to think about it is that I think the best point that the people who are far more dovish than I, like Paul Krugman, make is that unlike in the 1970s, we have not yet seen a big increase in 5 or 10-year inflation expectations. So right now, there's still a sense that we're in the range of price stability and that this has some temporary element in it. And that puts a lot of wind at the back of anybody trying to reduce inflation. But if we let this continue for too long, we will lose that advantage. And that's why I think it is likely that the total cost of containing the inflation will be lower if we act more rapidly rather than if we act less rapidly. And I think it's important to remember that core inflation right now, on the last figure was 7 to the nearest round number. And that was more than the month was more than the quarter, and the quarter was more than the half year, and the half year was more than the year. So it certainly wasn't coming down fast. And after yesterday, we've got interest rates at 4. So it's not like we're stepping on the brake with unprecedented force or anything like that, or anywhere close to stepping on the brake with unprecedented force. So for now, I think the risk of doing too little is greater than the risk of doing too late. And I make one other point. The Federal Reserve or some other central bank should have raised rates more and been more disciplined about inflation. Everybody worries that the Fed is going to move too quickly, that they're going to forget the lags, and then we're going to get an economic downturn. And that's certainly something that has to be balanced. And in general, I think it's better to worry about negative scenarios that have occurred before than negative scenarios that have not occurred before. That doesn't mean there isn't a risk, and that doesn't mean that the Fed doesn't have to strike a balance. But to put the point another way, is anyone really thinking that we're going to have such a bad recession that it's going to push inflation below the 2% target? And if we are serious about the 2% target, then why would we think that policy had been too contractionary if inflation is not falling below the 2%? Now, there's a set of arguments. I understand them. I think they wouldn't be my arguments that we should not have a 2% target. We should have a higher target for inflation. But gosh, when you've made the kind of mistakes the Federal Reserve has made over the last year and a half of not taking inflation seriously, and pounded away at your commitment to a target, this doesn't seem like the moment to abandon that target. Volcker's disinflation pushed the unemployment rate to 10.8%. And nobody, not the fiercest hawk anywhere on the planet, thinks we should elevate unemployment halfway to 10.8% from where we are now. The second is this seductive idea, and I think it is seductive, that we can just get rid of the vacancies and not have any increase in unemployment. Here's the fact. Right now, the excess of vacancies over their normal level is about twice as large as it normally is in periods of strong economic performance.
Right.
So the number of vacancies we might have to eliminate is kind of 2x. There have been 9 previous instances since World War II when vacancies came down significantly. In every one of them, unemployment went up substantially. So maybe it will turn out that this one is different. And you can argue that there's special features of the post-COVID economy. You can argue that precisely because vacancies are so high, this time is different. But in general, if you had to bet with 9 previous experiences or bet with no previous experiences and optimism, I think the better bet is with 9 previous experiences. But again, anything is possible. Frankly, the argument you're making looked better to a lot of people, including me, 5 days ago, before they got the most recent vacancies data, because there had been a big decline in vacancies last month without any increase in unemployment. But now a quarter or a third of that decline got revised away, and about half of that decline got reversed. And so you're seeing it much less right now. There were 3 differences between the Inflation Reduction Act and the Rescue Act that took place at the beginning of 2021. First, the Inflation Reduction Act was $600 billion over 10 years, whereas the Rescue Act was, plus the earlier stimulus, was $2.8 trillion over 1 year. So there was a total difference in scale. Second, the Reduction Act was paid for fully by tax increases and other revenue increasing. So there was no net change in the demand balance. And third, substantial parts of the Reduction Act were measures that would increase the economy's supply potential over time, not simply pump up the level of demand.